Welcome to the Explainer. You know, it's wild to think about, but have you ever wondered how a military strike literally thousands of miles away can instantly make your morning commute more expensive? Well, today we're unpacking a really fascinating and frankly pretty sobering report from KB Valbury Securitas. We're looking at the 2026 U.S.-Israel versus Iran conflict. So let's just dive right in, because we're going to trace the undeniable butterfly effect of geopolitics. We're going to see exactly how these distant shocks send massive ripples straight through the global supply chain and right into our local wallets.
I want you to keep this specific question in the back of your mind as we go through today's explainer. How exactly does a distant conflict dictate your local economy? We so often look at global events as just, isolated news stories. But in our hyper-connected world, it's really a story of cause and effect. Think of it like a giant set of falling dominoes. A military decision made in a war room one day can literally dictate inflation, currency values, and your cost of living on the completely opposite side of the planet the very next week. It's crazy, but it's true.
All right, here is our roadmap for the ripple effect. We'll cover the Middle East escalates, global energy choke point, shockwaves in financial markets, the higher for longer era, impact on Indonesia's economy, and finally, the road ahead.
Section 1. The Middle East escalates.
Okay, to really grasp the economic fallout here, we first have to understand the unprecedented shift in the conflict itself. So before 2026, the Middle East basically operated on this precarious balance of power, right? Rivalries were mostly channeled through proxy warfare. Think of allied, non-state actors in Lebanon, Iraq, and Yemen. It was essentially a strategy of indirect containment. But early in 2026, that dynamic fundamentally shifted. The classic security dilemma, where one state's defensive actions are viewed as offensive threats by another, well, it basically completely failed. And that pushed the entire region out of indirect containment and straight into direct, state-on-state military strikes.
The gravity of that shift was absolutely monumental. On February 28, 2026, the U.S. and Israel launched coordinated military campaigns right inside Iran's borders. These were reportedly codenamed Operation Epic Fury and Operation Lion's Roar. And these strikes resulted in the confirmed death of Supreme Leader Ayatollah Ali Khamenei, along with a bunch of other high-ranking defense officials. Obviously, this triggered a period of national mourning, a sudden leadership transition, and crucially, immediate retaliatory missile and drone attacks across the whole region. The first massive domino had officially fallen.
Section 2. Global energy choke point.
So how exactly does a regional war mutate into a global economic crisis? Well, the answer lies in geography. Take a look specifically at the Strait of Hormuz. Because of the combat actions happening in the Gulf region, this absolutely vital corridor immediately saw disruptions to commercial shipping traffic. Why? Because of massively heightened security risks. The threat of a de facto closure of this strait is literally the nightmare scenario for global energy flows.
Get this, roughly 1/5 of the entire global crude oil trade, we're talking millions of barrels every single day, passes through that one single narrow choke point, along with a huge chunk of liquefied natural gas. And under standard energy economics, prices are incredibly sensitive to even just the perceived risk to supply, even if not a single drop of oil is physically cut off. Just the mere probability of a disruption at this specific choke point instantly sends global energy risk premiums through the roof.
Section 3. Shockwaves in financial markets.
Now, this physical vulnerability instantly infected global trading floors. Look at how perfectly this psychological domino effect plays out right here. As the geopolitical risk index spikes, you can see those massive yellow bars. The fear and greed index plummets at the exact same time. Market participants took one look, immediately abandoned greed, and rotated heavily into extreme fear. Pure panic set in. And you know what? That fear translates into hard costs. We can see Brent crude oil reacting strongly to those energy risk premiums, but simultaneously, the Baltic Dry Index, which measures global freight rates, just shoots straight up. Maritime security uncertainty means war risk insurance premiums absolutely skyrocket. Ships have to be completely rerouted. They need naval convoys. And these tighter security protocols severely expand lead times. It acts exactly like a supply chain shock, basically amplifying cost push pressures across all global trade flows at the exact same time.
Section 4. The higher for longer era.
Let's zoom out a bit and look at the broader macroeconomic picture. A transmission channel is exactly what we are witnessing right now. It's basically the mechanism through which a shock over in the Middle East spreads to infect global commodity distribution, logistics, and ultimately inflation.
A sustained increase in energy and freight costs generates what we call cost-push inflation. Higher oil prices raise headline inflation directly, and then those secondary effects spill over into things like food, transportation, and manufactured goods. It just cascades.
And here's exactly how investors react to all that inflation and uncertainty. The flight to safety. Notice this dramatic surge in gold prices. Now, normally, capital might flee to U.S. Treasuries during a crisis, right? But the report notes something super fascinating. With rising U.S. fiscal vulnerabilities, higher war-related spending, and mounting concerns about debt sustainability, those safe haven flows have actually become way more selective. Gold basically outperformed as the preferred hedge against both the geopolitical instability and the revived threat of stubborn, higher-for-longer inflation.
Section 5. Impact on Indonesia's economy.
So, how exactly does this systemic macro-financial risk event crash onto the shores of a local emerging market? Well, let's look at the direct pressures on Indonesia. Even though Indonesia is obviously not directly involved in the conflict, it is a net oil importer. And that right there is the critical vulnerability. A global crude price spike directly translates into imported inflation for them. It means rising energy import costs, which in turn seriously increases the burden of domestic fuel subsidies on the government. It pushes up transportation and production costs across the board, driving up headline inflation and potentially widening their current account deficit. It's a real squeeze.
Another totally severe pressure point is the exchange rate. As global capital flees straight to the US dollar for safety, emerging market currencies take a massive hit. You can clearly see the intense downward pressure on the Indonesian rupiah right here. The twin risk scenario, where a country faces an external deficit combined with foreign capital flowing out of the country, can severely amplify currency depreciation and financial market vulnerability. It's a really tough spot to be in.
But hey, it's actually not entirely a one-sided doom and gloom story. There is a really vital nuance to Indonesia's position. While its status as a net importer of expensive crude oil is for sure a massive vulnerability, Indonesia also has a built-in economic buffer. It's a major global exporter of commodities like coal, palm oil, and nickel. So the report points out that during a broader commodity supercycle, the gains from exporting these materials can actually partially offset the fiscal pressures of importing that expensive oil. So they do have a bit of a shock absorber there.
Section 6. The road ahead.
So where do we go from here? The long-term pain and the overall magnitude of this butterfly effect basically depend entirely on four main pillars. First, will these disruptions remain just a matter of market risk, or are we going to see actual physical supply constraints? Second, how responsive will major producers and strategic petroleum reserves be? Third, can central banks actually maintain their credibility in anchoring inflation expectations? And finally, the perception of fiscal sustainability in major economies is really going to dictate how capital flows around the globe. Honestly, until these factors are settled, markets are going to remain highly volatile.
And that leaves us with this final, really lingering question to ponder. Will this remain a market risk driven by fear and premiums, or will it become a true physical supply crisis where the oil actually stops flowing? The next economic domino to fall depends entirely on the answer to that question. Thank you so much for joining me for this explainer. I really hope this structured look at the data helped clarify exactly how geopolitical shockwaves travel from a distant battlefield directly to the local economy. Keep learning, stay curious, and I'll see you next time.